Hello everyone, good afternoon. Today we're going to be discussing a recurring question of whether or not we need the Fed. The Fed is the Federal Bank of the United States, and today we're going to be getting into a few different topics that range from what their policies are, their responsibilities, their mandate, how they've responded to major financial world crises, and also what would happen if there was no Fed. So,
Alright, so just a brief intro on what the Fed actually is. It's the central bank of the United States that was created in 1913 to promote a safe and sound monetary and financial system for the citizens of the United States and the economy of the country as a whole. It's tasked with implementing monetary policies that promote maximum employment and stable prices to provide people with economic opportunities and growth to make planning for the future easier and more efficient. It includes a board of governors who are all appointed by the president, which is a 14-year non-renewable term, and they rotate, so every couple of years there'll be a new board member, as well as 12 regional federal banks around the country. The chairperson of the Fed right now is Janet Yellen, and that's a four-year renewable term. And the main federal bank is New York, and that's the one that controls whether the Fed is buying or selling bonds in order to increase or decrease the money supply.
I will be discussing the mandate of the federal bank. A mandate is akin to a mission statement, as it lays out the objectives that an organization wishes to accomplish. The mandate of the Fed consists of 6 parts. Part 1, conducting monetary policy. Second, promote the stability of the financial system. Third, to maintain economic efficiency. Next, to supervise the actions of financial institutions. Fifth, it works to protect consumers and preserve financial development in all communities. Lastly, the Fed acts as a lender of last resort to solvent companies during times of recession.
The Fed has 4 main responsibilities. The first responsibility is monetary policy. Monetary policy is important because monetary and credit conditions in the economy help pursue maximum employment, moderate long-term interest rates, and stable prices, which are all goals of the Fed's mandate, as well as supervision. Supervision is important to the Fed because it is necessary in order to regulate banking institutions to ensure safety and soundness of the nation's banking and financial systems, in order to protect credit rights of the consumers. Third is maintaining stability. Maintaining stability in the financial institution helps contain systemic risks that may arise in financial markets. Last is providing financial services to depository institutions. The United States government and foreign officials also, including playing a major role in operating the nation's payment systems.
next we're going to talk about the most recent financial crisis, which was happened in 2007 2009. That was a macroeconomic disaster that wiped out jobs, depleted the American economy, and completely destroyed the housing market. The first thing that the Fed did was that they reduced the federal funds rate by about 5%. The federal funds rate, as a review, is the interbank borrowing rate at which, like overnight lending or something like that, and it is based on an uncollateral basis. The second thing that they did was that with that reduced federal funds rate, they purchased large-scale assets, and these large-scale assets were able to stimulate the credit within the housing market, as well as provide a little bit more of the private and public borrowing to increase. Thirdly, they bailed out big banks that unfortunately were really greedy and took advantage of a lot of their clients, as well as took no responsibility as to what happened during 2007, 2008, and 2009. The fourth thing that they did was they dropped the interest rates tremendously in order to stimulate the economy and urge borrowing. However, they did this at one of the worst times possible because there was no credit available and there was no demand available. So the real question is, do we really need the Fed based on these very questionable actions? Well, we're about to find out.
Okay, so if there was no Fed, basically the responsibilities of the Fed would have to fall on someone else. Most likely they would fall on the SEC and FDIC, which is the Security and Exchange Commission, and the Federal Deposit Insurance Corporation. Both of these institutions already have plenty of responsibilities of their own. The SEC largely being involved with maintaining the safety and investors in the market. They fight against fraud and they investigate insider trading and other things like that in big banks. While the FDIC insures deposits and repairs the damage done by institutions that fail. So basically, that's just an insurance blanket for the banks. Without the Fed, both of these institutions would be way overwhelmed with responsibilities and the tasks that relate to the money supply, interest rates, and economic stability. Basically, they'd have way too much to do and wouldn't be able to give the attention needed to everything that they would have to do. Supervision and monetary policy are key responsibilities of the Fed, and without it, economic stability would be very difficult to achieve because it takes a lot of care and you have to be very attentive to the money supply. Without economic supervision and the regulation of the money supply, it would be very easy for the economy to gain extreme inflation or stagnate to a point where economic growth becomes dangerously low. In addition to the Fed's responsibilities regarding supervision of monetary policy, it is also the lender of last resort, meaning it lends money to quality firms during financial times of struggle. Just like in 2008, when a lot of the big banks were failing, they had to bail them out, and the banks then repay at a later date. Without this function of lending, solvent firms would be going bankrupt during recession, and instead of having banks just recovering or merging, there would just be more banks going out of business, which would lose jobs, and it would go completely against the goal of the Fed.
I will be discussing the Fed in the current day. Thus far, in 2016, the federal bank has not raised rates, keeping them between 0.25% and 0.5%. This is considered to be historically low. The reason for the absence of an increase in rates is due to the low economic growth and inflation sitting at 1.6%. This is well below the Fed's target rate of 2%. Despite the recent increase in economic activity following the election of Donald Trump for president of the US, bond markets have been extremely low as of late. For that reason, my colleagues and I believe that the Fed will not raise rates this year.
In short, the answer is yes, but there is a much lengthier reason why. The Fed is unique because it is neither a prosecuting regulatory agency nor is it a private bank, meaning it does not look to restrict the maximization of resources in financial markets or have to pressure to achieve profits for its stockholders. It's a unique institution, and it works in the best interest of the entire economy through three primary strategies: maintaining price stability, preserving economic growth, and maximizing employment.
So as you were able to see all the different viewpoints, all the different facts, you can definitely create your own opinion on whether or not we need the Fed. However, my colleagues and I believe that through maintaining price stability, preserving economic growth, and maximizing employment, the Fed does a great job, and it's its own entity, which means it's unbiased. And we think that the Fed is definitely needed in the economy because those monetary policies will have to be implemented at some point or another. Therefore, we believe that it is unique and it works for the best interest of the economy. Thank you.